Over the past few years, the oil market has been under pressure from various fundamental factors, causing a sharp drop in prices. No wonder global upstream investments have also slowed down. In the absence of investment, supply falls quickly. According to International Energy Agency, declines in output from existing oil and gas fields have gathered speed, with implications for markets and energy security. Without continued investment in these fields, the world would lose the equivalent of Brazil and Norway's combined production from the global oil balance each year. Meanwhile, the global oil demand is rising. According to the latest IEA report, it could be another quarter of a century before the world reaches peak oil demand. Shifting decarbonization goals, rapid growth in electricity consumption, and slowing adoption of electric vehicles are factors shaping its revised long-term outlook. The growth will be driven mainly by developing countries in Asia and Africa, with a simultaneous decline in Europe and North America. According to the same report, global oil demand could increase to 105 million barrels by 2035. Oil is the basis of modern civilization. It powers not only cars but also ships and airplanes, serves as fuel for electricity production, and is used in the petrochemical industry. The new report also highlights that it has taken almost 20 years on average to move from issuing an exploration license for oil and gas until first production, including nearly a decade to discover new fields and a further decade for appraisal, approval, and construction. Detailed analysis of the production records of oil and gas fields from around the world reveals that the global average annual decline rate in output from existing oil and gas fields is above 5%. As IEA Executive Director Fatih Birol said, only a small portion of upstream oil and gas investment is used to meet increases in demand, while nearly 90% of upstream investment annually is dedicated to offsetting losses of supply at existing fields. The International Energy Agency estimated in its report that the world will need the equivalent of an additional 25 million barrels per day in new projects over the next decade to maintain market balance. So, the oil and gas industry needs to run fast, just to stand still. You wonder who will benefit from this? The obvious beneficiaries will be companies from the drilling sector. Especially the offshore drilling has the highest potential to grow. This is a result of a combination of factors, such as ongoing depletion of onshore reserves, political and market factors, alongside cutting-edge extraction technologies that mean previously unreachable deepwater reserves are now accessible. According to Precedence Research forecast, offshore drilling market will more than double over the next decade. The top offshore drilling companies include global giants like Transocean, Valaris, Seadrill, Noble Corporation, and Odfjell Drilling. In this video, I'll examine two of them, which are getting momentum and have significant upside potential. Odfjell Drilling. Odfjell Drilling, a Norwegian company, is the owner and operator of the largest harsh environment ultra-deepwater offshore drilling fleet in the world. With its modern fleet, high-quality customer base, and long-time market presence is best positioned to take advantage of the current cycle upturn. Its financial position remains strong, with growing revenue and net profit in each of the last 3 quarters. All units are sold out until at least the end of 2026, with total order backlog of $1.5 billion. Increasing day rates secure higher revenue in the coming period. Supply and demand analysis shows favorable market balance in the coming years. Importantly, the dividend has been growing for last 4 quarters. Higher earnings and future free cash flow support further dividend increase. So, let's sum up. Odfjell Drilling operates the largest harsh environment fleet. Long-term contracts with high-quality customers and firm backlog support its strong financial position with growing sales and profit. Increasing day rates and favorable market balance are an advantage. Growing dividends provide a strong incentive for value investors. Okay, now the numbers. Odfjell Drilling, listed on the Oslo Stock Exchange, is currently trading at price-to-earnings ratio of approximately 15. Price-to-book value is 1.46, and the dividend yield almost 7.7%. That's quite a high dividend, and a fair valuation for such a renowned company, with meaningful upside potential. Now the next one, Noble Corporation. Noble Corp is a leading offshore driller with the industry's second-largest floater fleet. Globally scaled, with industry-leading pressure drilling capabilities, is in position to benefit most from the offshore drilling cycle upturn. Deep relationships with industry-leading upstream operators, supported by long-term contracting, provide strong backlog. Revenues for the last 9 months have increased, and even though earnings reveal a short-term setback due to a mix of specific issues in third quarter, its balance sheet and cash flow remain strong. A full-year guidance shows stable results, even in a challenging period. With a strong backlog and a clean balance sheet, Noble is in a position to generate up to 20% free cash flow yield in the coming years, as industry utilization improves and its contracts move towards current market day rates. The company has also adopted a shareholder-friendly capital allocation policy, which should lead to attractive returns for common stockholders. Today, the company pays above 6% dividend yield. In recent years, it has also carried out a significant buyback. So, to sum up, Noble operates one of the industry's largest drillship fleet. Long-term contracts, growing revenue, and firm backlog provide substantial free cash flow. With the strengthening offshore drilling market, day rates are expected to rise. Growing dividend and a buyback are beneficial for shareholders. Current market capitalization is $4.9 billion. Price-to-earnings ratio is slightly above 20, and price-to-book value is 1. The dividend yield is well above 6%. The payout ratio of 140%, meaning the company pays out more than it earns, may seem strange, but it has an explanation. The loss reported in third quarter lowered net result, but the full-year forecast and cash flow remain stable. Noble's decision to maintain its 50 cents per share dividend for the fourth quarter stands out. This move signals management's commitment to ongoing shareholder returns despite a challenging earnings period. The valuation is even more attractive as estimates show that Noble's enterprise value today is well below of the replacement cost of its assets. Okay, as I mentioned before, there are many other companies in this industry which can be an interesting investment opportunity as well. A conscious investor can do his own research and choose a different one. For example, Valaris appears to have a favorable valuation too, but doesn't pay any dividend. Odfjell and Noble are my personal picks. Okay, that's all. I hope you liked it. Don't forget to subscribe.